Is Nokia stock a hidden investment opportunity or a trap designed to attract retail investors at the wrong time? Before you buy Nokia, watch this video. Most investors study charts and indicators. We take a different approach. We're going to analyze Nokia through the eyes of institutional investors and market makers by zooming in on supply, demand, and who is in control of the inventory. On Wall Street, there's a saying that goes, feeding the chickens. That's when smart money accumulates stock early, then distributes it back to retail buyers after the move. So, where is Nokia right now? Early accumulation or late stage distribution? Stay with us through the full video as we uncover whether Nokia is a bargain worth buying today or a stock to avoid. As a must, it is important to note that this video is for educational purposes and should not be used as financial advice. Bottom finders are not financial advisors, but a group of very smart technologists that know how to model data and perform quantitative analysis. So let's jump in. All right. So what you're looking at is a feature available on the Bottom Finders console. It is the supply and demand charting tool that we use. Essentially, this is the area that we're going to focus on for the time being. You have three key indicators up here and one down here. We have the demand line, which oscillates about between 40 to 60. Anything below 40 is considered demand zone. Anything above 60 is considered supply zone. Then we have the red line, which is the institutional investors' supply. And then we have the gray line, which is the retail investors' inventory. So what we're interested in is this incline right here, which reflects. So the demand grew here, the supply decreased, and then you saw that the retail investors got a hold of the inventory and they own it at this point. Now, this line right here with these guys is this on the daily chart. This is about the late February to about early April or maybe late March timeframe. So this increase right here was the result of this demand pop. Now, it got to a point where it consolidated, and that is where it came down for a little bit, and then it popped back up much stronger than what it had done before. So if we were to look at this slice again, on the net volume, which is the difference of inflows in volume versus outflows in volume, what you get is this right here. It starts with a minus 50 in terms of outflows. This is reflecting outflows at that point. And it begins to go to the positive side, whereas inflows, and then it gets up to about 80. So this from here to here is this from here to here. Now, similarly, you see another one that's from here to here and from here to here. So there they are. I mean, there's this one right here to here is this one. Okay. Now, the thing that I want to point out, which is very critical to this analysis, is this one from here to here, which is from here to here. So if you look at this biggest jump over here in price, which went from 8 to about 1020, 1030, 1040, that was done on very little volume right here. There's just about no major exchange of shares for it to jump to that level. And let me tell you why that is. First of all, it got up to a point where it began to consolidate. That is this point right here. This point is where the supply with the institutional investors hit rock bottom, or they had very little to wheel and deal. So they went into a consolidation phase. Maybe they had the opportunity to even sell it off at that point, but they consolidated. From that point, they accumulated enough inventory, and what they did was sell it into the demand right here, and with the intent of getting over this resistance. The reason that is important with that particular resistance is because that is where the shorts loaded up. Shorts came into the picture right here. They put their stops at $9. Now, their stops are buy orders because that's how they get out of their position. So what the investors came in, the institutional investors came in, they picked up a little inventory, and then they sold into the demand, popped through the resistance, they hit all the stops, and then because the stops are buy orders, it launched them into the stratosphere. This is what happened over here on very little volume. So this is not a stable increase in the price action. This isn't anything that I could imagine would have a foundation or be underpinned by any kind of price validity. You look at the PE ratio. This stock is sitting at 78 PE. Okay, Netflix is at 41, or sorry, Nvidia is at 41. So not even Nvidia is anywhere near this stock. This is like somewhere is around the Tesla scale of PE. I know Tesla is up in the 300s, but so looking at this pop right here is not really a pop that I think can hold a particular range in price. So if you are looking to get into Nokia, you're going to want to be very careful here and make sure you hedge. Moving on, we have what's called signals. Signals indicate when a particular stock is hitting a bottom. So we have this graph that essentially groups our signals into sectors. We have the 10-day, the 20-day, and the 30-day. In particular, the technology has been lighting up. Now, Nokia belongs to technology, but the particular industry within the technology belongs in is radio and broadcasting equipment, communication equipment. So, but what you will come to see is that they're not really participating in these signals because a lot of the stocks that belong in that industry are just simply far from the bottom. Same with consumer discretionary. They're experiencing some signals there. So this is definitely worth noting. Coming down to take a look at the technology sector, you could see that the radio and broadcast communication equipment is nowhere in here. So it's just not participating in the signals. That tells us they're way off the bottom. Moving on, we want to show you the supply and demand charts that we have over at Bottom Finders. For technology, we are seeing an uptick in supply and we are seeing a slight downtick in demand. Really not really a downtick. It's just maybe a lateral move from March to rather from the past 2 days. So we're seeing something here. It's not a pattern. We experienced an increase in demand over the past week or two, but now we're seeing it level off. We'll see if that holds. But looking at the radio and television broadcasting and communication equipment, we are noticing that the demand is high. Okay. Now, in economics, that tells you that this is at a premium. The demand is high. So you're going to pay what the demand is asking you to pay. The supply is low. So you're essentially are going to be buying this thing at a premium. Now, looking at the numbers between the last trading day, which would put it at Friday at this point, I think that's Friday the 17th, April 17th, next to the past 2 weeks, what you're looking at is the radio and television demand has increased by 2 points. The supply has increased by 3 points. So we're kind of in that error margin because we do have demand is increasing, but the supply is also increasing. There are also other stocks that belong in the sector as well, Ericsson and I'm not sure, I don't remember what that one is. The net volume is increasing, so that is to the positive side, and the on-balance volume is increasing as well. So there's definitely a slight tick, and I mean very slight, in the demand. Something worth noting. I would not put, frankly, too much money in there. If you do go into it, you just make sure that you are hedging. All right, and the other thing that I want to point out before we move on to the news and public awareness, looking at Nokia's holders and who is holding the stock itself, you're going to find that the majority of the stock itself is held by Nokia. First, you might think, well, that is great. That is a sign that they're buying their own stock. Well, it's great if there's institutional investors that are holding the stock as well, but there isn't really. You don't see Vanguard, you don't see BlackRock or State Street, you don't see any of those guys in there. There's FMR, and even then, their position is very little. But nobody's holding this thing. So again, we do look at other institutional holders to be in the game because it kind of gives puts added pressure onto the company to ensure that they get value out of it. So you're kind of riding on their coattails in that sense. But in this case, Nokia does not have anyone. So now this brings us to the news. The news is important to us in several ways, but mainly because it is often driven by institutional investors and what they want the retail investors to believe and the messaging that they want to give to the retail investor. So this is one of the ways that they use to either sell off or get the demand going for a particular position. So we definitely want to look at the news, but look at it from the institutional investors' perspective. So Nokia has been getting a lot of attention lately. Market Beat reports that Waterfront Wealth sold over 380,000 shares, which could simply mean that they were taking profits or adjusting their portfolio, or could it? At the same time, Jim Cramer mentioned on CNBC that he believes Nokia still has room to move higher, which adds to the positive sentiment around the stock. I don't even know why this guy has a job. It's unbelievable. Bank of America also upgraded Nokia, saying the company's optical networking business has strong growth potential. That's important because it's tied to the growing demand of data infrastructure and AI and that whole niche. However, someone has the sense to ask, like Yahoo Finance, on whether Nokia can keep its recent momentum going after surprising investors with stronger performance earlier this year. So they got to keep that up. They can't just throw out there one report and say we're done. Overall, Nokia seems to be in an interesting spot right now. There is some institutional selling, but there is also bullish analyst sentiment and optimism about the future growth. Look at the explosive growth on the chart and you decide if it can continue to run. So you can see the logic of what is happening on the price action, but then you could see what the news is ginning up about this stock. Something worth noting. Okay, so now we move on to what AI has to say. So the goal with AI is to see if there's anything out on the internet that simply we haven't picked up. And here's what AI has to say. It's telling us that Nokia appears to be attracting positive institutional money flow, with smart money likely moving into the stock rather than out. Remember, AI could be a few weeks old. Recent momentum has been fueled by Bank of America upgrading Nokia, citing growth in optical networking, AI data center demand, and benefits from the Infinera acquisition. So why is money flowing into Nokia? Well, you have AI infrastructure trade. Nokia is no longer viewed as an old telecom brand, so they're now doing fiber backbone. They're a fiber backbone provider. They're an optical transport supplier. They're a data center connectivity player. So they're sort of in that infrastructure space within that AI realm. The infra acquisition synergies. This expands Nokia's high margin optical footprint and improves relevance with hyperscalers. There's a Europe strategic preference. European enterprise and governments prefer regional suppliers, so they get all that over there. Relative valuation compared to an expensive AI name, Nokia offers a lower multiple exposure to the same spending cycle. So the stock recently hit a 50-week high with strong trading volume, which is often a sign of institutional accumulation. Remember, AI is lagging, so while one firm, Waterfront Wealth, sold 380,000 shares, that sale was relatively small compared with Nokia's daily trading volume. So why does it have this high trading volume? Somewhere is up in the top 10. The main reasons money is flowing into Nokia includes its growing role in AI infrastructure, fiber networks, data centers, along with the lower valuation compared with many expensive AI-related stocks. So it's at $10. People feel like they're getting in on the AI action. Overall, Nokia looks like a stock institutions are rediscovering as a value play tied to the AI and networking boom. I haven't seen anybody rediscover it yet. Current money flow suggests a bullish bias, with funds more interested in buying pullbacks than exiting positions. I think we're going to see something different here soon. Institution bias on trading desk views bullish. Nokia looks like a late cycle rediscovery trade where funds realize neglected stocks have exposures to hot themes like AI infrastructure. So, where does that bring us? The bottom line for us: Nokia's supply and demand analysis says it's in the supply zone. As a matter of fact, it's peaked in the supply zone on March 4th, consolidated at the end of March, and then institutional investors pushed it up to hit the short stops, which are buy orders, further pushing it up into the stratosphere. So, we believe the bump from 8 to 10 over the past 2 months is baseless and not grounded on real buying or fundamentals. Bottom Finders believes Nokia is at or near the top and at its more premium, so it's very expensive for its price. We see the stock tracing back to $8, if not lower. I'm sure some of you will disagree with this assessment, but I invite you to leave a comment. Thanks for watching, and be sure to look for our daily videos on supply and demand, stock, and sector analysis. If you found this video helpful, please subscribe to the channel and give the video a like. We truly appreciate your support. And as a thank you, we'd also love to invite you to visit bottomfinders.com and join our community, where you will get access to all of our supply and demand analysis tools. We also offer a no obligation free trial with unlimited features and no credit card required to sign up. Until the next video, trade smart and be patient for the right deal to come along. Adios.